Hello and welcome to the Realtor.com 2015 Housing Trends sponsored by Prime Lending. I'm your host Lonnie Rosales from The American Genius and Realuoso, and I am joined by Realtor.com Chief Economist Jonathan Smoke. Jonathan, thank you so much for spending time helping us to understand the market ahead of us.
You're welcome. Glad to be here.
Well, I want to jump right in because we have a lot to cover, and we appreciate you having the crystal ball and being able to tell us what's coming up. I want to know about mortgage rates, so let's talk about that. They've seen historic lows in recent years. Do you think this trend will continue?
Well, to talk about a crystal ball, you ironically picked the thing that most economists, including myself, got wrong about this year. Because this time last year, most of us were saying that we would see higher mortgage rates in 2014, and as we all know now, that's definitely not been the case. In fact, last week, the most widely followed official rate is the average 30-year rate that Freddie Mac reports. And last Thursday, they reported that we've had the lowest level this year at 3.89%, and that was factoring in a half a discount point. To give you a frame of reference, last year that rate was almost 4.5%, or almost 60 basis points lower this year versus last year. Other popular mortgage products, the average rate on a 15-year with a half a discount point is 3.1% today. That's about 40 basis points lower. And the average 5/1 hybrid ARM today is 2.94%, and that's roughly 60 basis points lower than last year. We also monitor bank rate, and their weekly numbers are released on Wednesday. And last Wednesday, they reported a 30-year of 4.07, but that included just an average discount point of 0.27. So essentially, the difference between the two is merely the discount points that are applied. And no matter what rate you look at, it's roughly half a point lower now than it was this time last year.
So that's a whole lot of numbers to digest, and I'm sure that consumers want to know, based on whether they want to buy or sell or where they are in the market, how long are lower rates going to last?
Well, that's why I'm much more confident about the forecast for rates going up this coming year rather than what we saw this year. Because several factors are off the table that were still wild cards last year. First of all, the Fed was involved with what they call quantitative easing, which impacted the mortgage market significantly. And as you may have seen in the news, quantitative easing, or QE as it's referred to, ended in October. So that's off the table. We no longer have the impact of
Hello and welcome to the Realtor.com 2015 Housing Trends sponsored by... Apologies, viewer. Please continue, Jonathan.
That's all right. The Fed is now monitoring actively for signs of inflation, and that's really how their stance is turned. And the reason is that the federal funds rate has been effectively zero since 2008, or right in the worst part of the financial crisis. So the scenario we're facing now for 2015 is literally a question of when, not if, that mortgage rates are going up. And from the when perspective, I'm betting on the spring. But the range of other forecasts go as far out as late in 2015 or early in 2016. In fact, the cover of the Wall Street Journal today talks about the Fed and the upcoming meeting that they're going to have next week. And for consumers, this might sound like a bunch of financial nonsense, but they're focusing on language that the Fed has been using, and they've talked about one cue is going to be that they are likely going to move away from using the phrase they're going to keep rates low for a, quote, considerable time, and instead they're going to change that to something like we're going to be patient with increasing rates. And ironically, that's exactly what they said or what they did the last time that they raised rates, which was all the way back in 2004. My bet is that we're likely to see 50 basis points of an increase by the end of 2015 in the official Fed funds rate, but the mortgage market tends to move ahead of those official rates, and you normally see increases that are a bit larger than the Fed funds rate reflected in many of the most popular rates. We saw that with the 2013 taper, and again, back to history in 2004, ironically, it's a very similar time frame. They changed the language that they were using to describe their policy stance with mortgage rates in January. In May, they dropped the word patient, and in June, they raised the federal funds rate. And guess what happened with the 30-year average fixed mortgage? Rates rose in April and actually reached their high point for the year in May before the Fed even did anything with the official Federal Reserve rate. So best guess from my perspective is that we'll start to see mortgage rates move up as early as April. We'll see the Federal Reserve increase the official rate sometime in the middle part of the year, and we may see 5% by the end of 2015.
So what does this mean for people looking to buy a home with a mortgage in 2015?
Well, I would highlight first of all that I'm pretty much in the midpoint of the range increases. The range of the most followed companies and forecasters is essentially between 4.4% and 5.4%. At the low end, you have Fannie Mae thinking it's going to be around 4.4%. And then you have, for example, the National Association of Realtors at 4.9%. We're at 5%. The Mortgage Bankers Association is at 5.1%. And at the high end, you've got the Moody's Analytics guessing that mortgage rates are going to be 5.4%. So it's a pretty broad range, but to the real heart of your question, it really takes an illustration to talk about what is going to be the impact to a consumer. So let's use the scenario of the lowest end of that range, 4.4%, which is Fannie Mae's position. Today, the median list price nationwide on Realtor.com is $214,000. So let's assume that you put 20% down on that mortgage and you close today at 4%. That means your monthly payment covering principal and interest is $817.33. Now, move the clock forward to December of 2015, and let's assume the same list, the same 20% down payment, and instead of rate of 4.4%, which again is the lowest end of the extreme. Now your payment has increased almost 5% to $857.30. But if that rate went up to 5%, as we're forecasting, that means your payment has gone up 12.44% to over $919 monthly. And if the MBA, the Mortgage Bankers Association, is correct at guessing 5.1%, then your payment goes up 13.73% to $929.53. Now, I use the illustration to be able to talk about a specific rate, but the reality is the percentages that I've just described are the same regardless of the price of home that you're purchasing. So the impact of these forecasting rates is that if you wait until those rates have increased over the course of the next year, you'll likely be facing somewhere between 5 and 14% higher monthly payments just from the rates alone.
Well, I like that you use solid examples because in the industry, we're all guilty of saying, now's the right time, hurry, hurry, right? It's a realtor professional's job to create a sense of urgency, but I like that you're giving solid examples of those numbers of how your actual mortgage payment changes with just these tiny fluctuations. 5.1, 5.0, it doesn't sound like a big difference, but I like that you said on paper it does. So let's talk some more numbers. We've seen home prices creeping up in recent years. Can you tell us what to expect if those continue to rise?
Sure. So prices have increased over the last 2 years. Some of what we saw, especially last year, was double-digit price increases, which were really an abnormal reflection of the fact that prices had declined or had corrected a bit too much by the end of 2011. We've seen prices moderate this year, and we're forecasting that prices are only going to be up about 4%, somewhere between 4 and 5% nationally next year. But as you might guess, if prices are rising, then those examples that we just talked about have additional increases on what the monthly payments are going to be, because the numbers I went through basically assume that prices remain exactly the same. So if I take 4% as the forecast for home prices, that means we're adding to the payment, so that low-end example of 4.4% mortgage rate now means your payment has gone up by 9%. My most likely outcome, meaning that prices go up 4% and mortgage rates are at 5%, means that the monthly payment goes up 17%. And if the MBA is correct, then it's 18% increase. And the way to really think about that yourself is that if prices go up 1%, you're going to have a 1% increase in your payment. That's really easy to understand. If rates go up 1%, you have a greater than 12% increase in your payment. And when both rates and prices go up, you add those two together to understand the impact on your monthly payment. And again, it's the same whether you're buying the most affordable house on the market or the most expensive home on the market. It really changes the amount that you have to pay on a monthly basis.
Okay, so it's confession time. I'm an English major, so there are a lot of numbers running through my head and just boom, some of it's about to explode. So are there any tools that you would recommend for someone like me that is just overwhelmed by this kind of information that could make it a little bit more approachable?
Absolutely. The mortgage calculator on Realtor.com is an excellent way for you to play what if. Because number one, it takes rates that are specific to your market, and we'll talk about that in a minute. And it helps you translate what the assumptions are about current rates into what your actual monthly payment, and it keeps you grounded because it also includes what your property taxes and your insurance rates are likely to be, again, based on where you live. But don't freak out. I enjoy talking to English majors. In fact, the love of my life was an English major. So I'm constantly trying to figure out how to make this as clear as possible. But one of the things we do need to talk about to understand this, and why you don't have to freak out necessarily, is that rates actually vary tremendously. We've been talking about these examples as if there's a single rate that applies to everybody in the country, but the reality is rates do vary, and as a result you have ways to mitigate the increases of increasing rates. So for example,
so why? How do they vary and why? Now you got me interested.
Well, if you go to Realtor.com, for example, and check the rates for your area in the mortgage section of the website, and today I can't speak to whatever market you might be looking at, but on average, you can see that there's a range of rates across different products, and there's actually a long list of products. But let me just talk about the most popular products overall, because effectively you can see rates as low as 3.27% on average with 0 points, and that happens to be with a 15-year fixed conforming mortgage. If you're looking for a 30-year fixed mortgage, we're at 4%, basically what we use in the example. But if you're looking at a 5/1 ARM and a conforming mortgage, that mortgage is at 3.63%. So in other words, if you saw that rates went up 40 basis points and you really needed to have a monthly payment of a certain amount in order to qualify for the mortgage, one option that you might have is to consider a different kind of product that would provide you the rate that would make the calculations work for your circumstance. Also, rates vary by location, and this is where it can get complex, but let me use some examples for you to talk about this. But rates basically vary by geography because banks are essentially looking for ways to balance their risk, and they want different kinds of products, and they want homes with mortgages from around the country. Over the last 13 years, if you happen to live in Oklahoma or West Virginia or Missouri or Florida, and Lonnie, I think you're in Texas, then you would have paid higher rates on average over the last 13 years. But if you happen to live in California or Hawaii or Massachusetts or the state of Washington, you probably paid lower rates over the last 13 years. Now, more recently, in the last 2 years, it sort of shifted where it was clear that the banks wanted more people with mortgages in the heartland of the U.S. So people in Iowa, Kansas, Michigan, Minnesota, South Dakota have all been tempted by lower rates. And over the last 2 years, Texas has actually gone from being more expensive on rates to actually getting better rates. But if you lived in Nevada or West Virginia, then you probably paid slightly higher rates. Did I just confuse the heck out of you?
No, but I think it's important for consumers to know that every person that walks into their lender has access to different loans and different rates, right? Simply based on their geography, their qualifications. But why does it vary so much? Can you explain that to our listeners?
Yeah, it's based on supply and demand, and it's based on the very specific circumstances of that individual, that location, and what banks are actively trying to do. In fact, if you go to the site today and you plug in a market in California or Washington, on a 30-year, you're going to pay about 10 basis points lower. But if you're in Texas, you're going to pay more than 12 basis points higher. If you switch to a 15-year, it's going to be roughly the same spread, and again, you're going to have California and Washington with slightly lower rates, and in Texas, slightly higher. But if you look like at the 5/1 hybrid mortgage, you're going to see that in Massachusetts, they're getting a great deal right now. They're paying 31 basis points lower than the average nationally. But if you happen to live in the District of Columbia, you're paying almost the same higher basis points. But it's quite simply a reflection of supply and demand and what the banks need to do to balance out their books. But it also just reinforces the nature of don't get caught by the headlines. Use the calculators, use the rate tables, or talk to a professional to help understand what would actually apply to you individually.
So that's when we talk about the substantial variation in rates. I'd like to know, you mentioned that these rates will rise. So what is affecting the change in these rates?
Well, this is a good news, bad news story, Lonnie. We basically are facing the fact that rates will increase because we basically finally have an improving and better economy than the best that we've had since 2008. In fact, 2014 is going to turn out to be the best year since 2005 for GDP. And it's going to end up being the best year since 1999 in terms of the total number of jobs created. And we're forecasting that 2015 is going to be even better than 2014. Not substantially, but we're forecasting a GDP slightly stronger at around 3%, and we're also forecasting slightly more jobs being created at 2.75 million jobs. So essentially, the Fed can now start turning from worrying about employment, worrying about the economy finally getting stronger, and now they're shifting their attention to be worried about inflation. And that's one of their mandates. So in fact, they are looking very closely at two things that will really help them understand when they need to increase rates. And those two things are wages and incomes and housing. Well, we know that housing costs are going up because you have home prices increasing, but you actually have rents increasing today at a faster pace than home prices are. So that portion of a typical household's costs are growing, regardless of whether you rent or you own. And then the last piece is wages. That's the component that really has been stubborn. We haven't seen wages and income grow very much, but very recently we started to see an uptick. And the forecast is essentially expecting wages to be increasing about 3%, but that's about 50% stronger than we've seen since the economy went through the recession. So the trade-off that we have to face today is that if we want higher wages, which we do, because that helps with consumer confidence, it helps with saving for a down payment, it helps to help folks improve their credit scores, and of course it helps to qualify for a mortgage. So if we want higher wages, then we have to deal with the fact that the economy is stronger and doing better. With that comes inflation, and with that comes the Fed acting to increase mortgage rates.
That is great news. Thank you for that summary, Jonathan. I want to talk now about the key trends ahead for 2015. What trends are you already starting to see take place? What are we looking to, what should we expect for the coming year for housing trends?
Well, the biggest theme for the year I would point out is the return of the first-time homebuyer. Basically, that's been what has been missing from the recovery since the housing market started to improve in 2012, 2013, and through this year. We basically have not seen the first-time buyer be as represented as they usually are. From a home transaction perspective in the real estate market, we would normally see about 40% of the market be first-time buyers, and instead we've been around 30% for most of 2014, for example. And so the biggest and most important theme for 2015 is the return of the first-time buyer, and that's principally a story about millennials. And to put it quite simply, I think we're on the cusp of that very old story about millennials being unemployed and living with mom and dad is very quickly turning into the biggest wave and impact on the housing market we're going to see for the next couple of decades.
So they're about to make an even bigger impact on housing. Brian from Twitter asks, do you see a shift in more millennials moving to urban areas in 2015? And when you answer that, I'd also like to know, we're talking about millennials, what is that going to look like? What will they do to the housing market?
Sure. So you have to appreciate their size. It's the largest generation we've had, and for definitional purposes, in case anybody's trying to say, hey, does this apply to me? I use the definition that's most common, that millennials include people born from 1981 through 2000. So 20 years, that gives them the same duration of baby boomers. If you use that definition, millennials today make up 90 million people in the United States. That is the largest generation, even bigger than the baby boomers that our country has ever seen. They represent 29% of the population, but they only represent 17% of the households in the country. So if you just compare and contrast those two numbers, you know that the trend has got to be that those households are going to grow until eventually the households are about in the same proportion that they are with the population. What does that mean for forecasts? It literally means that over at least the next 5 years, 2/3 of the household formations in the country are going to come from people that were born between 1981 and 2000. And as you pointed out, Lonnie, they're already having an impact on the market. According to several different survey sources, millennials represented about 37% of active home shoppers this year. They were already the dominant people on websites and visiting open houses in the marketplace. But only not as many of them converted. So they represented only about 31%, and this is probably the last year that the baby boomers will have a higher share of buyers. And actually, to say that they're not homeowners already is a misnomer, because 14% of sellers in 2014, according to the data from the National Association of Realtors, were actually millennials. Why this is changing is, well, it's a combination of, it's both an economic story and it's a life story. Basically, especially the older cohort of the millennials, the people that are born from 25 to 34, are seeing their economic circumstances improving significantly. We're seeing that this incredible year of job growth has actually favored the young. They've had growth in jobs at a 50 to 60% better pace than the overall population. But they're also quite simply getting older, and they're going through those life events that trigger somebody to think about buying a home. So you're seeing more marriages, you're seeing more births, you're seeing more people indicating they're planning to get married or to have a baby in the future. And so people have been talking about them as Gen Rent. I think that they're most likely going to be really more Gen Own over the next couple of decades, and they're really going to move the market. Now, to the question that you asked about the urban location, it is absolutely true that the millennials have a propensity or an interest that favors urban locations more so than the broader population. So, for example, out of active millennial shoppers this summer, 15% said that they would prefer an urban location, and that's in contrast to the total population, which has a preference of about 11%. So they're about 33% more inclined to want to live in an urban location. But make note of that 15%, because the reality is the largest percentages of millennials are interested in suburban locations. And in fact, the largest percentage is with closer in older suburban locations. So that's likely where we're going to see more of the activity. But bottom line, they are young. They are households that are having difficulty with qualifying. They're households that are right on the cusp of being able to qualify and even have the money for a down payment. And so that means it really favors, the trend favors the more affordable locations in the country and more affordable product and neighborhoods within individual markets.
So millennials are about to make a huge impact. I loved the word that you used, cusp, because I think that's exactly right. But Sharon from Twitter says that she loves young buyers, but if millennials are about to take over the housing industry, where is Gen X going? We're saying baby boomer, we're saying millennial, but there's still another generation to consider. What's going on with them in 2015?
Well, I'm an expert on Generation X because I'm a card-carrying member of that sad generation wedged in between these two behemoths of the baby boomers and the millennials. And in fact, we were shortchanged on the number of years that we get, so even that makes it difficult for us to compare. The Gen Xers aren't really going anywhere. They actually represented the third largest cohort behind boomers in the marketplace, and they weren't that far behind in terms of buyers. And they definitely are in those middle life years where they're approaching their highest earnings they've ever had in their life. And they're far more likely to actually be the families in the suburbs. The issue is, unfortunately, Gen X was born at the exactly wrong time because they were buying homes right at the peak of the market back in 2004, 2005, 2006. So they've been impacted a bit more by prices and being prices declining and being underwater on their mortgages. But they're not going anywhere. I'm expecting them to continue to be very strong, very focused on the suburbs because that's where the kids are, and I'm a perfect example of that. I live where I live because of the best schools in the area.
Well, so we now understand a little bit about where people are moving, what generations are buying what, and what's going on generationally. But Nathaniel from Twitter asked a really important question. He says, will banks be more prone to lending in 2015? And I am dying to know your answer on this one.
Well, I'm dying to know the answer to that one too, because absolutely, I would say that theme of credit and access to credit is going to be the most important question, and what really supports our forecast being accurate, or potentially home sales actually being even higher in 2015. We've had a couple of developments lately that seem to be setting the stage for an even more robust expectation for 2015. And in particular, I'll point to two things. First of all, under the direction of Mel Watt, the director of FHFA, he basically guided both Freddie Mac and Fannie Mae, because those are the government-sponsored entities that FHFA is responsible for, to basically clarify their reps and warranties. And those are essentially the rules that govern how a mortgage document is treated, and more importantly for the banks downstream, whether or not those banks face risks of those mortgages being pushed back upon them because of a mistake that could have been made, something even as simple as a typo, or on one page having the name of the home buyer with a middle initial, and on another page not having a middle initial. So they've clarified the rules. Those rules have been implemented as of the 1st of December, and most of the lenders are basically saying that they expect that to have a material impact. Why is that the case? Because over the last several years, at least since 2012, we've essentially seen no change in numbers that help you measure access to mortgages. And that's because in the absence of those rules being clear, lenders had to put additional cushions, or what they call overlays, on the rules. So if the minimum FICO score was truly 620, and that is the case for both Fannie Mae and Freddie Mac, maybe an individual bank will choose to make that minimum 650 in their circumstance, because they didn't want to risk any scenario of Fannie or Freddie later down the rule saying, oh, really, the minimum was 650. So we should see some of those overlays diminishing because of the implementation of these rules, and if so, that will be one area of improvement. The other area of improvement is news this week, and that's with both Fannie and Freddie Mac introducing lower down payment programs that basically are putting them back in the business of providing mortgages that qualified borrowers can obtain, that enables them to put only 3% down on a purchase. And if indeed being able to save for the down payment is the biggest impediment, that should have a pretty tremendous impact, again, with that first-time buyer segment, and especially with millennials. So credit is undoubtedly the big question, and those are two things that seem to be tilting towards credit being looser, but not in an irresponsible kind of way, in a way that actually gets us back to, say, 1999 or 2000 types of.
Well,
You still there, Lonnie?
I am. All of that is really great news, and I'm wondering maybe this is the year to buy that dream home. Do you see any changes going on with new construction in 2015?
Yeah, so that's been the other disappointing factor in the housing recovery so far. We have seen improvements in construction and the level of starts, but most of that has been in multifamily activity, and the vast majority of the multifamily activity has been for apartments or rentals. And we are forecasting that starts are going to be up double digits, 16% next year, and in particular, we think it's going to be the first significant year of growth for single-family construction at about 21%. We actually are far more conservative on our new construction forecast. That sounds fantastic, and it will be the biggest year of growth since the downturn began for single family. But we think that there are going to be some constraints, particularly on the supply side, because we don't see enough lots and labor and materials to be able to support something even more significant. And in particular, if you think about the growth, builders need to be building more affordable product, and I'm not seeing quite enough lots to be able to support more than a 20 to 25% growth in new construction. But regardless, you're definitely going to see more new homes on the market starting in 2015.
So, with new construction improving and credit potentially loosening, I have two questions for you that I think are really critical. First, do you think we're finally out of the foreclosure crisis from years past? What do you think of that? And further, have we learned from the lessons that got us into the foreclosure crisis to begin with?
Sure. Put me on the hot seat. Well, I'll start with the simple one. Are we ending the foreclosure crisis? And I think absolutely. I would describe 2015 as essentially the year we should be closing the chapter on the foreclosure crisis. And the reason for that is we've seen the distressed percentage of sales decline all throughout 2014. We're now down at roughly only 10% of all home sales are distressed home sales. And behind that, you see that foreclosure inventory, the amount of homes that are being held on banks' books, will have declined about 30% by the end of 2014 from 2013. And we're forecasting an even greater decline, a little bit more higher in the 30% range in 2015. And that basically means unless you're in one of the hardest hit areas that is still having problems and you happen to be in a judicial state that takes a little bit longer to work through the foreclosures, nationally the foreclosure numbers are going to be back to more normal levels. That's not to say that people won't go through foreclosures. Foreclosures are normal in the same way that you think about unemployment being normal. It's just we're going to return to a time where the level of foreclosure activity is on a normal pace, and it's something that the market can handle without distorting prices or causing a supply issue in individual markets. Now, have we learned our lessons? I believe we have. There's a lot of consternation, especially about those programs that I mentioned that address the heart of opening up availability to mortgage, especially for first-time buyers. And I'd like to point out a couple of things specifically that Fannie Mae and Freddie Mac are doing in conjunction with these low down payment programs. This is not a return to 2004, 2005 kind of programs that are in place. Number one, most of those mortgages they're saying are going to require education or counseling, so that would-be borrowers have to go through a program to essentially get certified that they understand their personal finances and they can manage the scenario. It is absolutely going to involve documenting their income and limit lower thresholds on credit scores. So today they're saying they'll follow the same procedures for documenting income and having a minimum credit score of at least 620. And in fact, they are indicating that very likely the folks that will qualify for these will essentially likely have other criteria that are going to be tougher. For example, they'll have to demonstrate that they have more savings or reserves in place to handle a disruption, potential disruption to their income. and they might be held to lower debt-to-income ratios or loan-to-income ratios in order to be able to qualify. And if you look at the mortgages that have been made over the last couple of years that are only 5% down, or the FHA mortgages that are 3.5% down, you've effectively seen no difference between the delinquency rate on those mortgages and mortgages that required 10% down, as much as 10% down. So I do think that this is a different thing. These are not ninja loans. These are not liar loans. These are real people with real solid credit histories, credit scores, and demonstrable income that will make them very low risk with providing these mortgages to them.
So with the closing out the foreclosure crisis and some of these newer programs that are emerging that you said are setting the stage for a potential rebound, should homeowners expect the value of their homes to rise?
Yes, absolutely. So we've lived through a period where home prices have gone up the last couple of years, so we're returning to a more normal psychology of expecting down the road that homes will be worth more tomorrow than they are today. We are forecasting that prices will be up about 4% by the end of 2015, and that reflects a more moderate appreciation level than we've seen the last couple of years. But I would point out that that forecast is returning us to more normal long-term historical conditions where home prices basically slightly outpace what inflation or overall price increases are doing. And why I'm very confident that prices are going to go up is because we absolutely are in a scenario that supply is tight. One of the things that held back real estate overall this year in terms of having even more transactions is quite simply that we have a very low level of supply around the country. There are many major markets in the country that today have an average days on market or average age of inventory that's under 2 months, and even some are under 1 month. And nationally, we're seeing that months of supply is around the five months range, when more typically that's been between 6 and 7 months. So we don't really see supplies increasing at a pace that condition of being able to describe us being in a tight supply scenario is going to change in 2015, and all the more reason to expect that prices are going to perform as they have historically and increase about 4%.
If a homebuyer wants to see what type of home they can afford based off of their own financial scenario, do you have any tools that you recommend them use to find out what they can afford?
Yes, I've mentioned a couple of tools when we talked about the mortgage calculator and doing what if and looking at our rates. And the same mortgage page, there's an affordability calculator. And it's a fantastic way to plug in your specific data in your market and see what kind of home you can afford, again, using real current prices, real mortgage rates, and real likely rates for property taxes and insurance.
That's really good news, I think. So before we get to some of the questions that people submitted by using the hashtag housing starts, where can someone go to read more in depth about what you and I have talked about so far today?
Well, we have great content on Realtor.com, specifically in the news and advice section. Actually, since I've joined Realtor.com, I've been writing a couple of pieces a month as well, and they are in the news and advice section. So many of the topics that we've talked about today, including the benefits of home ownership, can be found in the news and advice section.
Well, that is very helpful, and I think anybody that's either a buyer, seller, or in the industry should always dig a little bit deeper, not just because the stuff is interesting, but because it affects all of us. So we received a ton of questions from Twitter today, and we're going to get to as many as we can and kind of, fast shoot these. The first question comes from Deborah on Twitter, and she asks a really loaded question. What does the rental market look like in 2015?
Well, I talked earlier, but I'll reinforce the point that we're actually seeing increases in rents and asking prices for rents now outpace what home prices are doing. So for most places in the country, the scenario is quite simply that there are far more renters than we've ever had. The demand is substantial, and they can't build apartments fast enough. to change the fact that there's virtually no vacancies for rentals. So in that context, you can basically bank on rents going up for the foreseeable future.
And Bill from Twitter wants to know if the average time to stay in a home is still 7 years.
Oh, that's a great question. It's actually changed quite a bit. And if I recall from memory, the long-term average was about seven years. And you collect that data basically from surveys of sellers, and you see how many years they've been in their home. So, for example, every year the National Association of Realtors does a home buyer profile survey, and they report specific statistics. During the housing boom, when there were far more transactions back in 2004, 2005, 2006, we actually saw that tenure decline to 6 years. And I believe the latest number from 2014, from the report they issued in November, that has increased to 10. So essentially, you have seen people staying in their homes longer. And one of the assumptions that a lot of people are making about the impact of mortgage rates increasing over the next several years is likely to be that longer tenure continuing to dominate, because quite simply it's going to be harder for people a few years from now to be able to improve their condition by buying a home and having to pay a much higher mortgage rate at that point. So that's another great stat to focus some attention on.
And Tom from Facebook asked, how will the run-up to the 2016 presidential election impact consumer sentiment? And I'm actually curious about this because we're about to have talking heads on stages arguing about all sorts of topics and throwing mud on each other, and housing will inevitably come up. So what do you think consumer sentiment will look like in 2015 as we lead up to an election?
Well, we've been essentially seeing a very long-term recovery in sentiment, both measures that people look at to gauge how the consumer is feeling. One is consumer sentiment and one is consumer confidence. And both of those metrics are essentially at the highest point that we've seen for the last 7 to 8 years. We're not quite back to the level that you can say that consumers feel as good as they did back in earlier time frames, but it's definitely been moving in the right direction. Our forecast and many others have that continuing to increase, and I'd say we probably benefit from 2015 not being a political year with that regard, because actually the couple of times that we've seen consumer sentiment tank in 1 or 2 month periods over the last couple of years have when Congress and the President have done something stupid. Like fight over the debt ceiling or shutting down the federal government. So I think we can be thankful that 2015 is not an election year, just based on the economic forecast and the long-term correlation to consumers feeling better when unemployment is declining and when jobs are being created, essentially sets us up for a year that both consumer sentiment and consumer confidence should be going up. And I believe most of the longer-term forecasts have that improving even through 2016 and an election year.
That was a very good answer to a kind of tricky question. Thank you for that, Jonathan.
I live by the Beltway, so I'm working on my politics.
There you go. Samantha from Facebook wants to know about downsizing. It has been a trend over the last decade. Do you think that will continue, or do you think that as the market improves, we'll see people buying larger homes?
Yes, that's a great question, and I'm trying to think through how to describe this as simply as possible and not take up too much time. But basically, people buy product based on their age and their life circumstance. So the trend towards downsizing has more been correlated with older households that no longer have children in their home or no longer have the threat of adult children moving back into the home. And in fact, if you look at surveys of the 55 plus households that are essentially today dominated by baby boomers, they actually fall into a pretty equal distribution. You have roughly a third basically saying they do want to downsize. And what's interesting about that group that wants to downsize is they tend to live in some of the largest homes today. So the desire to downsize is often a reflection of you've got too big a home now, given your circumstances and the composition of your household. But actually, there's a third who say, I love the size of my house, but I'm considering a different house because I want to be in a different location. I want to be closer to family. I want to be in more of a retirement destination type of scenario. So there's roughly a third that don't want to change the size of their home. And guess what? Those people tend to live in homes that are right about average nationwide. And then there is a cohort that is almost as big as the cohort that wants to downsize in that group of 55 plus households that actually is planning on building the largest home they've ever had. And part of that, again, is their specific circumstances. Many of those folks are coming from smaller homes, so they've been saving for their dream home, and this represents their activity to finally get what they want with their kids out of the house, but they want plenty of rooms for the kids and grandkids to come visit. So we are going to see demand for smaller product. If that's ultimately what's behind the question, there's no doubt in my mind that we'll have a lot stronger demand for smaller product than we've necessarily seen. I mean, for example, did you know that over the last couple of years we've actually set records for the average and median square footage of newly constructed homes in the country? And that's basically what happens when you no longer have a vibrant first-time market and more affordable entry-level housing being constructed. So there's no question in my mind, especially because you've got this affinity with millennials to want to be in urban locations, that there's some trade-offs, and that probably means more attached product, smaller product, and as a result, we'll probably come off of some of those historical levels, especially on the new construction end of things.
So musical chairs, basically, huh?
What makes this business so fun?
Yeah. Well, Sam from Twitter wants to know, and this one makes me cringe, but I have to ask, what parts of the country are you projecting to slow in appreciation?
Okay. That's a great question. We actually put out my favorite 10 markets. I avoided actually numbering them because I was looking at essentially different criteria that landed them in my favorites. But the trend in home prices, I would say moderating and only increasing single digits, is pretty widespread. So we had a lot of markets in 2013 with double-digit price increases. You had a few markets in 2014 with double-digit price increases. And essentially, there are very few markets that anyone is forecasting to see that level of increase in 2015. Again, because mostly what we've lived through the last couple of years was a reaction of prices having gone down too low, and now they're more returning to standard values and more normal appreciation. Of the markets that stick out in my mind that probably will experience on the higher end of the scale, and again it's single digit, are probably the markets that have just now experienced more price appreciation. So for example, Philadelphia, I think, is one of those markets out of the large markets that had stronger price appreciation. And Atlanta, I have to mention Atlanta because they were one of my top 10 picks. And I think I've gotten a lot of flack in social media regarding picking Atlanta. But that's the whole point. You're focusing on where the hockey puck is going to be and not where it has been. And Atlanta seems to really to be turning the corner. And that's probably a market that will have stronger price appreciation than others.
That makes sense. Andrea from Twitter asks something that we've already addressed, but I think deserves another just quick second on this. She wants to know when the backlog of buyers not buying because they have something to sell will end.
Oh, that's a great question, and actually I think that's been one of the understated problems that's been hanging over the market over the last couple of years. It's not only the condition that many folks have talked about, which is the scenario of somebody being underwater on their mortgage is far less likely to sell, and that condition has been improving because prices have been appreciating. But the other condition is quite simply this. If you look at the credit tightness and the availability of being able to qualify for a mortgage, the math essentially dictates that at least 10% of current homeowners today couldn't qualify for a mortgage under the kind of standards that people have been held to over the last couple of years. So I think if we truly see the credit loosening, again, not to crazy standards like we had in 2004, 2005, 2006, but more like the time frame that we had in 99 or 2000, you're probably going to see a lot more people willing to sell, because I would absolutely say it's not just a great time to buy right now. It's a fabulous time to sell, especially if you're like a baby boomer and you're thinking about selling that suburban home and wanting to move to a different location, or to downsize or to upsize or whatever you fall in that continuum, because there are a lot of millennials that are having babies and thinking about having babies that are paying more attention to school districts and very well might represent the demand for those homes. So I do think 2015 is going to be, if the credit scenario changes, will be a year that we'll see more inventory as a result of people being more willing to sell.
Perfect. Jonathan, I have one last question for you. If all of this time we've spent together, we have shoved so many brains full of so much information, what is the one thing that you really want consumers to walk away with after this time we've spent together? What's the most important thing they need to know about the 2015 housing market?
Well, quite simply, from an economic and housing perspective, 2015 is going to be better than 2014. So a lot of these trends we've discussed is essentially going to be improving both for the economy and for home prices. The one thing that we paid a lot of attention to early on is that mortgage rates will be going up. So if you're focused on, hey, I can qualify, or I'm just about able, if I work very hard over the next couple of months, to save up the money for the down payment, there is no question that in the future your payments are going to be higher. And if you're trying to enter the property ladder, it's better to do that when you can qualify. But as we've discussed, a lot of very complex topics, and the fact that housing and mortgages are all about location, 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 please seek the advice of professionals. We're happy to see you on Realtor.com and using our calculators and using our mortgage data. But the bottom line is, we believe that those professionals, like your local realtor, play an important role in the process and should be helping you make those decisions, and whether or not now is a great time to buy.
Very succinctly said. Thank you so much, Jonathan. We are now out of time, but for anyone whose question wasn't answered, or if you have more questions, the conversation will continue on Twitter using hashtag #HousingStarts. And this 2015 Housing Trends has been brought to you by Prime Lending, who is offering real estate professionals and consumers $250 off of their closing if they just use the code Realtor14. Again, $250 off of Prime Lending closing costs with the code Realtor14. Thanks again, and we will see you next time.